Thank you for joining us. I am pleased to be joined today by David Rubenstein. He's the co-founder and co-chairman of the private asset giant Carlyle, and he's also the host of Peer-to-Peer by Bloomberg and also Bloomberg Wealth. David, thank you so much for joining us today. You look at the market this year, and it doesn't look at all like it looked last year, and there's a lot of fears about where it goes from here. Do you have a fear that what is happening with the Federal Reserve could set us on the course of a correction?
Well, I think we are due for a correction. The markets have been very ebullient for quite some time. We've been basically having free money, right? So interest rates have been so low. I think the Fed has indicated it's going to increase interest rates 3 or 4 or maybe even 5 times at some point this year and perhaps next year. So the market is anticipating that. But until it actually happens, I think the market won't really correct. But the market is weaker already this year than we would have expected. The economy is generally in good shape, but I think the Fed is likely to ratchet up interest rates, and that will, I think, put asset prices down a bit.
And in the near term, how is this inflationary story going to impact both investors and the companies that are grappling with these higher costs?
Yeah, inflation is something we really haven't had for quite some time. When I worked in the White House, we famously got inflation to 15% or something like that. That was in the 70s. Since then, we've been averaging 2% a year or so for inflation, relatively modest, or even less than 2%. Now we've just had month over month, 7%. And in fact, the 7%, the last number. So year over year, in effect, 7% inflation annualized rate. That's very high. We're not used to that. I think it will normalize out at probably something around 3 to 4%, but that's still double what we've had. So a lot of people are nervous about it. And obviously, people are now beginning to increase prices, and they're beginning to wonder whether their customers will go away or whether their customers will go along with these prices. So if you go and shop at a food market or something, you go to a restaurant, you already see the prices are moving up.
As you mentioned, that 3 to 4% is higher than in modern times.
Right.
So what does that mean for the new reality of the American economy?
Well, inflation is probably going to be a cost that we're going to have to live with for a while. It won't be quite as bad as it was in the 70s, but it's not going to be 2% for a while. And I think this is going to be with us as long as we have COVID and the supply chain problems. Because of the supply chain problems, people are unable to get products that they want to the market. So people who have the products are increasing prices. Also, it's hard to get labor, and you have to get labor. As you probably know, it's very difficult to get labor, work at some, let's say, lower income jobs, and therefore people are paying more to get these people to work than they would previously do, and the result is prices are going up. I think we're going to see this for quite some time.
This increase in labor prices, we saw that today with Goldman Sachs reporting compensation increase of 33%. Now, if you compare that with other areas like private equity, private assets, I mean, how do you put that into context, the price increases we're seeing for talent on Wall Street?
Well, the talent on Wall Street compensation levels are just defy gravity, so they're in a different league. The average person probably isn't really affected by the Goldman Sachs bonuses or private equity kind of compensation. The average person is really worried more about what it costs to buy some food or buy a car or get gasoline. And those prices are up a fair bit. And people have a little sticker shock now when they go to get a gasoline or they go to the supermarket. And I think that's going to be with the people for a while. We have to get used to it. And of course, the problem with inflation is it generally is harmful most to people in the lower incomes because they can't afford as much. So it's really going to hurt people who are blue-collar workers more than probably white-collar workers. The white-collar workers are experiencing it as well.
Well, what does this mean for equality moving forward? If we're seeing the labor increase so much in terms of price for some areas of the economy, whereas inflation eats away at others, as you mentioned.
Well, income inequality is one of the great problems that capitalism has never solved, and it's getting worse. As a result of COVID, people who don't have college education, people who work with their hands, people who are blue-collar workers, people don't have broadband, people don't have childcare at home, they're often falling further and further behind. They're falling behind so much so that I think it's going to be very difficult the next year or two for them to catch up. So income inequality is getting worse, not getting better. And social mobility is a big problem as well. So I wish I could tell you things are going to be better than I think they're going to be. There are going to be some challenges for a while. Now, I think Congress is not able to do anything about this. The Congress is not likely to pass major legislation going to solve all these problems. And of course, if Congress were to pass major legislation, a lot of it will be inflationary because at this point, a lot of the legislation they're considering is putting more money in the economy. And I don't think a lot of members of Congress want to do that right now.
So it's an interesting question going into the midterms as well. What does all of this at the end of the day, this inequality, these concerns about inflation, what does that say about the ability of the Democratic Party to garner more favor at a time where, on one hand, you had job growth, but on the other hand, you have people not able to pay their grocery bills?
Well, in midterm elections, after a presidential election, it's traditional that the president's party and the president's party will lose 20 to 30 seats in the House in that first midterm. I think many people think that will happen now. And if that were to happen, of course, the House would go Republican. It's also traditional that the party in power at the White House might lose 2 or 3 seats in the Senate. And I think if that were to happen, the party in control of the Senate would be Republican. With both houses in Republican control, I think President Biden's going to have a very difficult time getting anything passed along the lines of proposed before. He may have to adjust what he wanted, but I think it's going to reset expectations considerably if he isn't able to get Congress to do anything he wants. And now with Democrats controlling both houses, he still can't get exactly what he wants.
The cost of some of these spending bills, I want to visit with you because for a while here, we had very low interest rates. But as interest rates start to go up, how does that then start to impact the cost of how we pay for services in our country?
Well, right now, we have roughly $29 trillion of federal debt. And so every budget we have to put in the interest charges to pay off this $29 trillion or just pay the interest on it. When interest rates are 1% for federal borrowing, it's affordable, you could say. When interest rates go up by twice that or 3 times that, it's going to be much more expensive to pay off the federal debt. Therefore, something else has to get squeezed out. And it's not likely to be the military spending, and it's not likely to be entitlement programs like Social Security or Medicare or Medicaid. So it's going to be the discretionary spending of the federal government, which is shrinking and shrinking because there's just not enough money to pay for everything right now. So it's going to be a big problem as interest rates go up because we have this federal debt and we're not going to be able to avoid paying it.
So one more question here on politics, because you had mentioned the predicament here for the Democratic Party. But of course, you have worked with somebody who's very emblematic of the changes in the Republican Party. That's Glenn Youngkin, formerly co-CEO of Carlyle, and his rise in Virginia. I'm wondering your opinion on what that means for the changes we might see for the Republican Party ahead.
Well, Glenn Youngkin was in our firm for 25 years. I hired him out of, it was McKinsey at the time, very smart person, did a very good job at Carlyle in Europe and in the United States. He decided to get into public service. I didn't think he could win as governor right away because it's very difficult to go from private equity to being governor, but he ran a brilliant campaign. And his strategy was to pay homage to President Trump to some extent, but he never actually appeared with Donald Trump. And I think that enabled him to win the election. Now, I don't know whether other people will be able to do the same thing and win without actually having Trump show up, because in the Republican primaries and Republican caucuses, Donald Trump is extremely popular. In a general election in a state like Virginia, which is more or less a Democratic state, Trump may not be as helpful in a general election. So Glenn Youngkin came up with a model that seemed to work quite well, and we'll see whether he can continue to do that. But he's obviously an impressive person. And
on the flip side of things here, when it comes to Joe Manchin, and I know you've interviewed him before, what kind of control does he have over the plans of the Democratic Party and the ability to get things done this year? How might that take shape in the year ahead? He has an enormous amount of influence because until the Republicans win control of the Senate, and we don't know if they will, but let's suppose they do, between now and the time of that election, the Democrats have a 1-vote majority in the Senate. So if Joe Manchin is not in favor of something, or Senator Sinema is not, it's not going to go anywhere. And obviously, therefore, they have enormous amount of power. I think that the administration hasn't been able to come up with a formula on Build Back Better that pleases either of them. Therefore, I'm not sure that's going to pass. And the same is true on filibuster. So it's going to be very, very difficult. People should remember, though, Joe Manchin is in a state that is one of the most popular, where Donald Trump is extremely popular. I think only Utah did Trump get a bigger majority than he did in West Virginia. West Virginia is a very Republican state, and therefore, as a Democrat, he has to reflect to some extent the constituents' view throughout the state, and that's why I think Joe Manchin isn't able to all of a sudden do whatever the Democrats want. Now, for an investor, politics is obviously front of mind. So is the Fed. So are geopolitics. Of those forces, or another one that you may not see right away, which is the biggest impact to markets moving forward? I think going forward this year, the things that the market will be most concerned about is the pace at which the Fed will increase interest rates. Secondly, how big inflation is going to be. Third, what is the status of the U.S.-China relationship?
4, can the President of the United States get any legislation through or not? And therefore, it's a sign of his ability to do things and make the country more effective and so forth. And then I think overall, if there are going to be any international challenges that the president has to deal with, and if it's not dealt with successfully, is it going to make him weaker? For example, let's suppose Russia were to invade Ukraine. We don't know if that's going to happen. The response to that might be very difficult. And so if there's an international crisis, that's going to be a real challenge for the president. But sometimes when you have international crises, actually president's popularity goes up if they handle it well.
So back to the Fed for a second, because what it's going to also do is increase the cost of financing. We mentioned what that meant for the US government, but for investors as well. If you look at the stock of, for example, Blackstone last year, it doubled. But it started on a decline this year, as did most of its private asset giants, Carlyle included. I'm wondering how able and willing will investors be to put real money to work in a higher interest rate environment?
All the private equity firm stocks that are publicly traded doubled more or less last year. We all did quite well, in part because we were earning a lot of money and it was a good time to exit and so forth, and we were raising a lot of money. I think when you have to pay more for interest charges, it makes it a little bit more difficult to make the kind of profits you would like, but it's not that difficult. In other words, when interest rates were 10% or 15%, it was very difficult to make a profitable buyout, or harder. When interest rates are going up a little bit, it's not the biggest challenge. And I should remind people that when buyouts were first started, 95% of the capital structure was debt. So the interest charges were very important. Now the capital structure might have 30% or 40%, maybe 50% debt. It's not as much as it used to be. So it's not an insignificant problem. It's not as big a problem as it was many years ago when you were borrowing so much money.
Now, if you are a Blackstone or a Carlyle or an Apollo, how do you then compete with some of these venture giants that have been expanding? You see some of this already with some of the big private equity firms traditionally going into growth equity and investing in Silicon Valley and technology companies.
Well, the large publicly traded private equity firms, Blackstone, Carlyle, Apollo, and so forth, what they're offering is a brand name that is well known around the world. They've got a deep bench of people, and they can do many different things: growth capital, buyouts, private credit, real estate, and so forth. If you're a specialized venture firm and you're done quite well recently, you're going to raise a lot of money in venture. But I don't think the venture people are going to go into the buyout world so much, or the private credit world. Now, venture people are going into growth capital, and that's where a lot of people are meeting, because growth capital can consume a lot of capital. When you're a large publicly traded firm like Blackstone or Carlyle, putting out $1 million in a deal doesn't really move the needle. So you want to put out more money to actually make things more profitable for your investors and so forth. And so venture capital doesn't usually work at these large publicly traded private equity firms, but growth capital can, because you can put out a fair amount of money in growth capital. So I suspect all the large publicly traded private equity firms are going to be more active in growth capital.
You famously had once said that you missed out on the opportunity to invest in an Amazon.
Right.
So I'm wondering then, how much of a inclination is there for you or many of your peers to be a part of the next Amazon, to be a part of the next big growth story?
Well, today, everybody is afraid that they're going to miss the next big Amazon. And so you see lots of people investing in lots of companies that have no revenue, modest business plan, and so forth, because they think this might happen. In fact, some of these companies have gone public recently, and some through SPACs have staggering valuations that aren't justified by normal standards. But people are not looking at the downside so much. They're worried about missing the upside.
Well, does that mean you think that a lot of people will hit zeros at the end of the day?
Some people will hit zeros. Some people will do quite well. Nobody really knows which way, a particular investment will go. And right now, the fear of losing money is not as dominant as it was closer to the last recession. When you don't have losses for quite some time, and people who are younger in the markets, they haven't been through a correction, they haven't been through a recession, they're not really used to that, and therefore they tend to put money in thinking nothing will go down, and we will see some corrections and people will lose some money.
Well, does that mean you think that people need to get more fearful at this point in time?
I think people should be more cautious than probably they are. I think valuations are very high. I participated in agreeing to some of these valuations in investment committees I participate in, but I'm always nervous about it. It used to be in the buyout world, you paid 7 to 9 times cash flow, more or less, for a buyout. Now, you can't find any buyouts at that price. You probably are going to pay 10 to 15 times cash flow, and maybe in some cases even more. In the venture world, it's completely different. But growth capital today, you're often paying 20, 30, 40 times cash flow, or sometimes 10 times, 15 times revenue. So these numbers are quite staggering, and some of the deals are working out and some may not.
So I'm wondering what this means about your propensity to invest in some of the potential moonshots moving forward, some of the newer industries like crypto or blockchain or space. To what extent are you willing to dive in?
Well, there are two different issues. One is when you have a fiduciary responsibility to other investors or people that are investing with you, you have to be a little bit more cautious. But sometimes investors say, I want to be in the next big thing. I'm willing to lose money or have a risk of losing money. So I do think the three areas you mentioned are quite attractive. And I have invested personally in these areas, in blockchain and in crypto related things, and also in space. And I think other areas that you're going to see is things like quantum computing, artificial intelligence, more life science kinds of things, taking advantage of CRISPR. These kind of investments, I think, are going to likely do quite well. But nobody really knows for certain. Predicting the future is difficult. Right. Investing is all about predicting the future. And nobody can really predict the future. But right now, the technologies I just mentioned, those areas seem to be among the most attractive ones in the new technologies that are coming along.
Now, how do you get comfortable when you don't know what the revenue prospects are going to be in so many of those areas?
Well, investing is about intuition to some extent. So Warren Buffett is probably not sitting around looking at 500-page memos about whether he should do this or not. You have a certain intuition and a certain experience, and you feel it might be a good idea. And then if you're wrong, you go on to the next thing. Great investors are willing to go against the conventional wisdom. Great investors also follow their gut, and great investors are willing to admit a mistake and go on to the next thing. If you're afraid of making a mistake, you're not going to be a great investor.
So what does that mean in terms of, I'd be really curious for you to bring us under the hood here on what your investments look like when it comes to quantum computing, to space, to Bitcoin. How much of your wealth are you really willing to put up when it comes to those newer investments?
Well, new areas, I tell people, if something that's very risky at the beginning, don't put more in than you can afford to lose. So let's take, I don't own cryptocurrencies, but I do own companies that service the cryptocurrency industry. When people go to Las Vegas, very often they know they're going to lose money gambling, but they enjoy it. They just think it's fun, and pleasure is worth losing money. So if you get pleasure out of following cryptocurrencies up and down, and it gives you thrills to see the market go up and maybe make a lot, do it if you can afford to lose that amount of money. It's gambling related money. But if you're really talking about your net worth and taking serious amounts of money and potentially ruining your net worth, I wouldn't recommend that on any new technology. It's just not worth the risk. The most important thing about investing is not losing what you have. You can take some risks and you might lose some of it, but don't lose all that you have and don't take undue risk. The great investors are not taking all their money and risking in one new currency or one new type of technology. So try different things. And ultimately, when you're investing in a tough atmosphere as is now, you're probably going to lose a little bit more than you would have a year or two ago. A year or two ago, the markets were so ebullient, it was hard to lose money. This year will be more challenging.
You have a book coming out this year that will speak to a lot of this, these themes that you've mentioned. You've talked to a lot of investors to write this book. Do you feel that some of the largest investors in the world, many people who focus on value for so much of their lives, will be missing out when we look at the new economy?
Well, value investing means, like Warren Buffett would say, or Seth Klarman, I'm buying things that are really worth, even if the economy turns down, they're going to be really, really worth something. I would say, though, value investors had a tough time in recent years because the prices have been so high, there have been a lot of values. Now I think the value investors will probably come back into their own a bit because I think prices are going to come down and there are going to be some real problems with some of the companies that were bought at too high a price. For example, right now, about 90% of the SPACs that went public are trading below the issue price. Now, that doesn't mean they're not a good company. It doesn't mean that they won't succeed. But right now, about 90% are below the issue price. So that tells you something about a little bit about the ebullience of the SPAC market.
So what does this mean then for not just the investors, but for the talent moving forward? There's clearly a new economy being built in front of us, but it's not clear to me that the skill sets are the same as what investors are allocating capital to. Do you worry that as a country, we're not investing in the right things when it comes to training up a workforce?
Well, that's a complicated question. I think young people are the key to good investing, and you have to get young people interested, and they have to make mistakes and learn and so forth. I think the country shouldn't have a central authority saying we should invest in this area or invest in that area. That kind of central planning usually doesn't work. I think you have to let the market forces determine what's really good and not. And ultimately, some of the things we just mentioned, quantum computing or CRISPR technologies will take off and some will not. We just don't really know. That's the joy of investing, is taking some risk. But I think the young people in this country and other countries increasingly find the pleasure of investing more than maybe they did 50 years ago. When I graduated from college more than 50 years ago, very few people said, I want to be a professional investor. And not as many people were begging to go to business schools.
You wanted to be a lawyer.
I went to law school. I thought that was a higher calling. It turned out that I wish I had gone to business school as well. But I think today more and more people are interested in taking a chance. More and more people are interested in risking some years of their life to learn a new trade. And I think investing has a good benefit for this reason. If you have good investors in a society, they're going to give capital to good companies. If good companies get capital and they grow, it's going to be good for society, good for employees, good for the productivity of an economy. So I think investing is an art that is important to society. There is no Nobel Prize for investing. Mr. Nobel never had that. But I do think that investors do useful things for society, and I do think that it's a really good profession.
But do you think that, if we go back to the beginning of this conversation and we do hit a downturn, that the same will be true, that more people will be drawn into investing if there is real money to be lost in the coming year or so?
Well, inevitably, if something goes down, people run away from it for a while. Excuse me. But I think inevitably people will come back to it, because if you are an investor, you can be well compensated. There's no doubt that if there wasn't a 20% carried interest rule or carried interest participation in venture capital or private equity, you might not find as many people rushing in that area. When you can get 20% of the profits on other people's money, you tend to attract people who are interested in making money.
Now, I want to take a question from the audience, and it's really relevant on a day where we had Larry Fink's annual letter out on the idea of stakeholder capitalism. As someone who studies politics, do you think business will eventually be a moderating factor in the partisan environment, or will they continue to play both sides?
Business people generally like to know what the rules are, and they want to keep their head down and not cause problems. Now, in recent years, business people, and Larry Fink is one of them, have been saying we have to speak out on social issues much more, like climate change. And I think that's a good thing. But generally, business leaders are trying to find the least controversial way to move forward. I don't think that we can depend on the business community to get Congress to do things that they should be doing. Congress is in a different area, and I don't think most business people are going to spend their energy trying to say, members of Congress, let's come together. I wish they would. And business people have a lot of influence. They have a lot of employees. But I think most business people are just not going to be trying to convince politicians to do what they want.
But it's interesting because at the same time, you see Congress being very divided, not just with companies and the worry about companies becoming more woke, but also with institutions, with the Federal Reserve, real worries that have arisen from different parts of the aisle about getting too involved or not involved enough when it comes to social issues. How do you think that plays out?
Well, I think business people should be more involved in social issues. I'm just saying that I think a lot of them are still reluctant to do so because they don't want to upset one side or the other side. Also, you mentioned that Congress is divided, but Congress is not divided so much as the country's divided. Congress really reflects where the country is. Now, obviously, there's gerrymandering and so forth, but by and large, the country's split down the middle. And by and large, I don't think you're going to get a lot of major change out of Congress because the country is split down the middle.
Humor me for a minute on a spitfire there on certain issues. How do you think this starts to play out this year when it comes to issues like gun control?
Gun control is an issue that all members of Congress recognize is a death type of issue for them politically. There is nothing that is to be gained for most members of Congress getting involved in gun control. And I don't think the Congress is going to pass any gun control legislation of any type, in my view. I just don't see it.
Do you think that, and what about voting rights? I mean, that is also going to be a hot button issue. Do you think corporations will be more vocal this year?
I think corporations will give some lip service to it, but I don't think they're going to really expend that much energy on it. There are some great people doing things in voting rights, Ken Chenault and others doing some great things, but I don't think it's really going to have the impact they would like. And I would say that, to be honest, right now, if the 1964 Civil Rights Act, the epic Civil Rights Act of our lifetime, were to be on the floor of the Congress, I don't think it could pass.
There are so many other issues, but we only have a minute left here. Do you have final thoughts about what investors, anybody watching the markets or the economy really should be worried about in the year ahead or thinking about?
The most important thing to worry about is knowing what you're doing. Do the research. Don't just rely on somebody else. Make sure you know what you're doing and make sure that you're prepared to admit a mistake if you made it, and then go on to something else. And don't put too much money in any one area. Don't think you're going to create the next Amazon or Apple yourself by putting some money somewhere. It's very unlikely. The most important thing about investing is don't lose what you have. So be very cautious, get respectable rates of return, and don't try to be the next Warren Buffett. It's very unlikely that's going to happen.
That's compounding over time, right?
That's correct.
Thank you so much. That's David Rubenstein. He is the co-founder and co-chairman of Carlyle. And I'm Sonali Basak, Wall Street reporter for Bloomberg Television. Thank you again for joining us.